Welcome to the Wealth Academy educational series. Learn how to invest like the pros. I'm Adam Khoo, and in this segment, we're going to be talking about how you can create a multi-asset portfolio to hedge your investments against any market condition, to be an all-weather portfolio, if you will. So before I carry on, I'd like you to pause the video and read and understand the disclaimer before I carry on. Okay, great. So there are many assets you can actually invest in. I'm just going to focus on 4 of the main ones. The first would be gold. And the easiest way to invest in gold is through ETFs or exchange traded funds. So for example, you can buy the GLD, which is the gold ETF. And this ETF can be bought and sold through the broker. It's listed on the stock market and it tracks the price of gold. So as gold goes up, so does this gold ETF. Gold goes down, ETF goes down. The second major asset would be, of course, the stock market. So again, you can look at emerging markets, European markets, US markets. For the purpose of this video, I'll be just looking at the US markets, represented by the S&P 500 index. And again, you could buy the S&P 500 index ETF, known as the SPY or the spider that tracks US stock prices. The third major asset would be commodities. Now, of course, gold is part of a commodity, so this would be all the other commodities. For example, oil, copper, silver, agricultural commodities like coffee beans, cocoa, right? And there are many commodity ETFs. One of the biggest ones would be the DBA that tracks a basket of commodity prices. The last major asset would be bonds. So again, you can buy physical bonds, but an easier way to do it would be to buy bond ETFs that track bond prices. There are 2 main ones. One is called the TLT, which is the long-term 20-year bond ETF that tracks 20-year bonds. And you've got the IEI that tracks medium-term 5 to 7-year bonds. So how did these 4 assets perform over time? Well, it depends on the time period, right? The phase of the market. In certain markets, gold does well. In certain times, gold doesn't do well. In certain times, oil does well, and vice versa. Every asset has its day. Every asset goes through bull markets and bear markets. So if you look at this particular period from 2007 to 2015, stocks went through a bear market or a downtrend over here during the financial crisis. Okay, and then when the crisis was over, it went to a very strong uptrend. If you take the entire period, the compounded annualized return of the S&P 500 be about 8.17%, excluding capital gains, or rather excluding dividend yield, sorry about that. And dividend yield approximates about 2%. So if you add it together, it's about 10% annualized return. If you just were to buy it here and just hold it all the way to here, and closing your eyes as it went down, because you're averaging out for the medium to long term. Now, during this period, what happened to, for example, bonds? Okay, so you can see that in that period, as the stock market went down over here, bonds actually went up. Okay, because bonds are seen more as a safer haven than stocks, right? So as the stock market went down, right, people move more into bonds, which are fixed income instruments that pay a fixed interest. And as the stock market went up, bonds actually continued to go up as well. So in general, bonds will start to come down when there's an anticipation of the rise of interest rates. So the moment people expect interest rates to go up, bond prices tend to go into a downtrend. But during this period of time, if you remember, the Federal Reserve was cutting interest rates to stimulate the economy, right? And that actually gets bonds going up. So sometimes stocks and bonds move together, sometimes they may move differently. In fact, times when the Federal Reserve is cutting interest rates to boost the economy is when they are pessimistic about the economy. That's when the stock markets go down, right? At the same time as they cut interest rates, this increases bond prices. So those are times when bonds and stocks may be a good hedge against each other. Let's look at another bond ETF called the IEI that again looks very similar to the long-term bond ETF. And this one returns about 5.23% with a coupon yield of 1.4%. Next one is gold. So you can see that gold from 2007 to 2013 went on a very strong uptrend. So during the financial crisis, when stock markets were collapsing, gold was going up. Because again, when do people buy gold? Right? People tend to buy gold when interest rates are dropping, when there's a fear of inflation, when there's money printing, and people think that money is going to be useless, they buy gold and gold goes up. But I can see in 2013 over here, gold started reversing into a downtrend. Why? Because that's the time when they said, hey, we're going to stop money printing. We're going to stop the quantitative easing. We're going to start to increase interest rates. So the moment there's anticipation that the US dollar will get stronger, okay, that's right. Gold prices will tend to come down, and so will other commodities as well, like oil, for example. Okay, so if you look at gold over this entire period, the annualized compounded return is about 9.13%. Finally, these are all the other commodities in the basket: oil, gold, agriculture, and so on and so forth. And you can see that for this entire period of 1, 2, 3, 4, 5, 6, 7, about 9 years from 2007 to 2015, they went nowhere. Now, commodities did really well from 2007 to 2008. Look at that huge run over there. I mean, if you bought that, you'd have a few 100% return. Okay. Now, this was mainly contributed by the rise in oil and gold. Why? Again, during this time, the US dollar was dropping because they were cutting interest rates. So when you cut interest rates in a country, the currency tends to fall. They tended to print money, so the value of the dollar fell. So when that happened, commodities tend to spike up like that. And then eventually what happened was there was a slowdown in China. China is one of the biggest buyers of commodities, and that caused the commodity market to collapse. It attempted to recover a bit, but it's now continued to go on a downtrend because, again, slowdown in emerging markets and now the increasing strength of the dollar. So there are many, many factors that come into play that will drive all these markets. The point I'm making is this: if you were to put all these assets together, this is what's going to look like. When one does well, or when one is bullish, another one could be bearish. Okay, I don't like to use the word doing well and not doing well, because let me put it this way. Market going up is good as a trader when you go long, right? You buy low, you sell high. But when the market is going down, that's also good if you're shorting the market. So in a way, well, there's no good or bad market. It's just bullish or bearish. So bullish means we're going up. Bearish means we're going down. So again, over this period of 2007 to 2009, that was the financial crisis. Stocks were bearish. Stock markets collapsed by 50 to 60%, as you can see over here, right? But during that period, gold went up, right? Gold was bullish. Oil was bullish because they thought we were going to run out of oil, right? Gold was bullish. Bonds were bullish. So during this period, if you held all the assets in the right proportion, you would find that you would have so-called lost money in stocks, but you would have gained huge profits in gold and oil and bonds that would have offset that loss in stocks, give you an overall profit. All right, and that's what's hedging all about. The profit outweighs the losses, so you still make money. Now, in this period over here, from 2013 to 2015, it was the opposite, right? Now, gold's going down. Gold's on a downtrend, right? So gold's losing money, as you can see. Oil's going down as well, so oil's losing money, right? But the stock market is going up, okay? Because the US economy was recovering, and bonds were kind of like going sideways. So again, the huge profits in stocks would have offset the fall in gold and oil, and a slight increase in bonds would have offset that as well, again giving you a profit. So the point is, if you can buy all these assets in a portfolio, we call it a multi-asset portfolio, and they hedge against one another, they will assure you that in whatever market situation or period, you're going to be profitable. All right? So here's an example of a multi-asset allocation strategy which you could just buy and could just hold it passively. So they will hedge off each other. So for example, for every $100 you have, or $100,000, whatever, 30% will be used to buy stocks, specifically the S&P 500 ETF, okay, or the SPY. 40% will buy long-term bonds like the TLT ETF, 15% in intermediate bonds like the IEI, 8% into gold, the GLD, and the other 8% into the other commodities like the DBA ETF. And so this kind of like balances this off. Now, the question people ask is, why don't we allocate it equally? The reason is because these assets have different levels of volatility. So stocks are, for example, more volatile than bonds. Okay, they move faster. So I've created an allocation such that it kind of like equalizes the volatility, so it balances off very nicely. Now, the important thing is that this portfolio should be rebalanced annually. So what does this mean? For example, year one, you have $100,000, you allocate it in this proportion. 1 year later, let's imagine that stocks do really well, right? The stock market doubles, okay, and what happens is your investment in stocks doubles in price, okay? Now bonds go down in price, so you're losing money on bonds. So what happens 1 year later? You'll find that out of the money which you have, a lot more of it's in stocks because they rose in value, and a lot less would be in bonds. So for example, now stocks could account for 50% or 60% of your portfolio because they rose in value, and bonds maybe account now for 20% of your portfolio. So you have to rebalance it, and what that means is that you got too much stocks now, right? So you got to sell part of the stocks so that it goes back down again to that 30% percentage, and then redeploy that cash back into bonds. Now this may sound a bit odd, okay? So in this approach, basically you're selling what is doing well and you're buying what is not doing that well, okay? In an attempt to rebalance it. Now this is an approach known as passive investing, and it's a way of rebalancing. This approach assures that in any situation you don't lose too much. In fact, you would break even or make a bit. But this approach also assures that you also won't make a lot of money, all right? Because when a market does really well, it'll still be pulled down by something else. So it's a passive method. Now, if you are more of an active trader, you want higher returns, then don't do it this way. Another approach is using trend following, which means you look at the individual assets and either go long or go short, depending on whether the asset is on an uptrend or on a downtrend. So for example, in a particular situation, stocks are on an uptrend. And if you watch my other videos, you will know how I determine the dominant trend. It's either an uptrend, downtrend, or sideways, right? So in this case, stocks are on an uptrend, as shown clearly by the moving averages. So we go long on stocks. Now at the same time, during that period, gold's on a downtrend, right? As you can see from the moving averages. So what you do is you short gold. So you go long stocks and you go short gold. And in this approach, you don't do any rebalancing. In fact, you add more to the winners. As stocks are going up, you buy more. You buy on the dip of the uptrend. As gold is going down, you keep selling more gold by short selling it when they make temporary rallies on an uptrend. So this approach is a very different approach from the previous approach I talked about. And both approaches work. It depends on which one you want to employ, you're more comfortable with, you've got more time for. And this is how you can make money in a multi-asset portfolio. This is Adam Khoo, your instructor. From Wealth Academy, learn to invest like the pros.